We all know hedge funds can be risky, but they may be even riskier than their investors and their managers realize. Charles Gradante is here to explain. He's managing principal at Hennessee Hedge Fund Advisory Group. Charles, we appreciate your being here. What is the undiscovered elephant in the room for hedge funds?
Well, we're noticing that equity hedge fund managers are getting into credit default swaps. They are buying credit default swaps, making a bet that spreads will widen. And what we're concerned about is that this is a bond product, and equity managers typically don't understand the bond markets, and in this case, the credit default swap market.
So what's at stake? I mean, how many people are playing in this? What could a blow up do to the industry?
Well, there are 15 major dealers in the credit default swap market. They're mostly banks and insurance companies. There is $27 trillion globally of credit default swaps that are out there in the marketplace. The risk is that we have equity hedge fund managers who have been herded into the feeling that spreads are about to widen since they're at 8-year lows. The Merrill Lynch high yield spread relative to treasuries are at 8-year lows. And so everybody's on the same side of the fence. The risk is that if there's someone on the other side of the fence that has a concentrated bet against spreads widening, there may be a problem with a hedge fund or perhaps a small bank that has received an allocation from a big bank to take a piece of the trade that the big banks are selling to hedge funds.
And Charles, I just want to put something in context, because when you said $27 trillion, just for viewers, I believe that is bigger when you talk about the credit default swaps out there than the combined economies of the United States, Japan, and China. I mean, it's a huge number.
It's a huge number.
But even central bankers who have talked about this on the U.S. Fed, Charles, they've said, hey, you know, it might be a problem, but it might not be. No one's really sure how diffuse the risk is. So on a scale of 1 to 10, how worried are you?
Well, the fact that no one really understands the risk is got to be closer to an 8 or a 9. I mean, the banks, like in long-term capital's case, they didn't understand their exposure to long-term capital's trades, and that's why long-term capital was bailed out. That was my testimony at the House in 1998. In this case, we're hearing the banks saying the same thing, that don't worry about it, but we're not sure what the risks are. Don't forget, there are counterparty risks out there that have not been dimensioned. No one really knows what banks, what insurance companies, what hedge funds are holding what kind of risk. Are they long CDSs or are they short CDSs? And are they hedged or are they making a directional bet? That's the issue.
So, Charles, what would regulation do to help this problem?
Well, some of the CDS contracts are regulated, but many of them are over the counter. They're written with clauses that are not standardized, and so they're unregulated. And when you get into an unregulated security, like Amaranth had many unregulated energy contracts on their books, you have hidden risks that only the manager may realize exists. So we feel that investors in hedge funds should be asking their consultants or their fund-of-fund managers what they know about the credit default swap risks that are being taken under in the equity hedge fund strategies, more so than the fixed income strategies, because the fixed income guys pretty much know how the bond market works and how the CDS market works. Now, in 1994, hedge funds did a dollar-yen trade where they borrowed in yen at a very low interest rate and invested in the bond market, and the equity hedge fund managers were down 23% in 2 months. So it was a directional bet. The Fed raised rates 1%.
And they got hit.
So in this case here, if we have a default or a quick widening of spreads like we saw in 1998 with long-term capital, we could have someone sitting with a directional bet that could damage the institution, a small bank, or a fairly large hedge fund.
All right. Well, we'll be very curious to see what happens. And thanks so much for explaining it, Charles. We appreciate it.
Thank you.
Charles Gradante with Hennessee Group. All right, Street Signs. We'll be back in just a moment.